Good afternoon, folks. It's Dave Burrows, Chief Strategist and President of Barometer Capital Management. And I want to thank you for joining us on another Tuesday afternoon Barometer Readings webcast. So here we are, we're in September. I always think of it as the beginning of a new school year. People on Bay Street and Wall Street are back to work. And hopefully we're going to see, some additional liquidity show up as the trading has been fairly choppy. But there's lots of things for investors and traders to digest. And we're going to try and take things sort of from the top down and look through some of the numbers as to what we're seeing going on underneath the market. Now, clearly, we're in a run up now to a midterm election. And so some of those things come into play. There's been all kinds of things to think about in Europe, not the least of which is an absolute parabolic move in European energy prices or power prices. Lots of worry about conflict between Russia and Ukraine and shutting off gas to Europe and what that might mean to countries like Germany, frankly, major manufacturers. And we have lockdowns again in China, and certainly markets are following that. As of this morning, something like 60 million people locked inside their homes. So lots of things to think about, markets digesting it. And frankly, today was sort of a quiet day. Now let's just talk our way through some of the top-down data. Most people know that we believe we've been in a structural bull market since 2013 in equities. This is the U.S. stock market. It's been much like it was in the 1980s and 90s, albeit relatively short so far, and the percentage returns since the beginning in 2013, again, relatively muted. Not to say that you don't see good-sized pullbacks in a structural bull market, but they tend to be fairly short and sharp. And when they're over, you get kind of 4 steps forward. So that's, of course, what we all hope is the case, but we have to be realists. We have to look at the data underneath the hood to see if it continues to line up that way. When we look at the last 2 structural bull markets, here we are coming out of the bear market in 2013 that we entered in the year 2000. During that period, you had 2 prolonged declines. This was the tech wreck or the end of growth stock outperformance. During that period, frankly, there was money to be made in some sectors, more old economy, more value-oriented groups, but the dominance of the growth stocks as a percent of the index had an outsized impact on the S&P returns and certainly on the NASDAQ 100. The 2007, 8, 9 bear market was obviously quite different. It was a recession that turned into a credit crisis. And this was after years and years of deregulation left the banks in a very vulnerable position. Some of them levered as many as 40 times on their capital. And ultimately, there was a systemic risk that took the market down around 50%. So the corrections that we've seen since then have been relatively shorter and more muted, not to say they weren't painful. We all remember what happened in 2018's fourth quarter. That was a particularly tough one for us. 2020, going into COVID, was very difficult. And, the last 7, 8, 9 months have been difficult for the S&P. The worst point, the S&P was down 24.7% as of June the 23rd. But at this point, we would say there's a lot of things that make us believe that this continues to be more of a reset in a long-term bull market than a major watershed shift into a secular bull market. Not to say it can't be the case, but it doesn't look likely at this point. If you look at the SPDR, which has been trading since 1992, which is the proxy for the S&P, the similar picture, you can see that we've been in a pretty well-defined channel all the way along here, going back to around 2008. And we continue to be we tested the top end of the channel at the end of 2021. We tested the bottom end of the channel in June of 2022. And here we are retesting these lows if we look at it from a broad market perspective. So let's look at it a little bit more closely. About 3 weeks ago, we looked at the S&P and noted the fact that we were running into a declining 200-day moving average. We were also running into a declining trend line that had been in place since the market put in its top at the beginning of the year. and that we were well extended above the 50-day moving average. All three of those suggested perhaps we might see a pause. Not to mention the fact that we were into the beginning of August and we know that there is difficult seasonality in August and September and in October. Those three things made us just talk about the idea that we could see some choppiness as we got into the fall. So certainly we were stretched above the 50-day, and we highlighted the fact that over the next number of weeks, we might see a little bit of choppiness, but we weren't talking about something that was significant. We were talking about the fact that likely we had to just digest a little bit to work our way through. So here we are now as of today, and the picture is different. We have pulled back from that upward down channel, the 200-day moving average. We moved back and moved down to the bottom end of this channel as defined by the low in June, the higher low later in midway through July, and where we sit today. So there's always going to be at these points a discussion with the bulls and the bears as to what's likely to happen next. I've had all kinds of folks highlight to me that there are analogs running around the internet comparing the current market to the market in 2008 or the market in 1974, where once it made a low, it had a failing rally and then waterfalled down below. And I'm not saying that that's impossible, but at this point, it does not look like that's the case. We have to continue to assess things day by day. There's all kinds of markets that after bear markets bottomed after 23, 24%, did come back and retest, and maybe we test some more, but ultimately hold a higher low with fewer stocks breaking down on the second sell-off that ultimately resolve to the upside. What the analogs fail to identify or show is the number of times you did have a successful retest of those lows, and then markets work their way higher. So we keep an open mind to the fact that things can always get worse, but I will say, based on sentiment, based on positioning, based on outright bearishness in the market has digested a tremendous amount of news over the last 9 months, both politically and financially, from an inflation standpoint, from a conflict standpoint. And here we sit above the lows from June. So let's look a little bit deeper. Let's talk first about interest rates. We had a view that we saw a structural low in interest rates in 2020, perhaps a generational low. And we highlighted that the bond market, this is the 10-year yield, had been pulling back since 1980. We recently had traded above the declining long-term moving average, and we digested that rise, and now we're back sort of at the highs. If you take a look at the TLT, this is the long-term US government bond ETF, it's down about 40% from the highs. So to be clear, as asset managers, as investors, we have to decide where we should be putting money to work, what has a structural tailwind, and what has a structural headwind. When you have a breakdown like this in a market that's been rising ultimately for 40 years, you have to take it seriously. This is the most significant bear market in bonds since 1981. This is the ETF for the aggregate bond index, down 17% from the highs. In fact, if we close the week out here, it would be a new weekly closing low. So it doesn't look like bonds are the best place to put money, and not to say they can't turn if inflation starts to come down. But at this point, there's really no sign of that. In fact, if we look at the aggregate bond index return, this has been a very significant pullback, the most significant pullback, even more significant than what happened in the late 1970s. But from a timing perspective, this has been going on a while. It's been 25 months since the bond market made a new high. That is a substantial period of time. And it's not to say that we can't get a bounce. But at this point, fixed income is not the place we've been focused on to generate returns. Not to say we don't have some short-term bonds as a source of liquidity, but we're not looking for strong positive returns there. From a commodity standpoint, we've talked about the fact that commodities, after a very long drought, have been relatively outperforming the S&P. But frankly, it's been very short in the scheme of things and likely to go on for some time. The RJI unweighted index of commodities in decline since 2008 broke that trend back in 2020 and month by month worked its way higher. And while the stock market has been very weak over the last 3-4 months, certainly hasn't made any progress, but on a relative basis is holding up much better than the stock market. If we look at Brent crude, after a long period of underperformance, making a low in 2015 and then a lower low in 2020, escaped this secular bear market consolidation. And you've seen rising relative strength. This is versus the QQQ, or relative strength versus the NASDAQ or growth stocks since then. And we certainly are consolidating. It's not to say we can't consolidate some more, but on a relative basis, especially in this recent pullback of the last 3 weeks, relatively outperforming nicely. When we look at agriculture, it's the same story. Relative outperformance started late in 2020, pulled back a little bit in the spring, but through the market's bounce and certainly in the market's pullback over the last couple of weeks, agricultural products continuing to relatively outperform. So commodities is an area that is interesting. And whether it's energy or whether it's certain other basic materials, they probably provide an alternative and a hedge against inflation, and perhaps a hedge in a reflationary environment that they haven't been for some time. Now let's move through some other data. If we take a look at leadership, let's just start by defining what we're trying to do. We know that 80% of return comes from getting to the asset class that has a tailwind and the sectors within those asset classes that also have a tailwind. They're getting to the right neighborhoods. 20% of return comes from finding the right securities within those neighborhoods to express the view. So I talk a lot of macro because we think it's really important to understand the backdrop of what we're working with. So in simple terms, what I'm saying is equities from a long-term perspective continue to be in a bull market, despite the fact we are in a sharp and painful correction. Commodities also look as though they are into a longer-term bull market, and fixed income is solidly in a bear market. From a sector perspective, we have to identify which sectors we want to focus on and which ones perhaps we avoid. They don't all act the same. We know that for many years, growth-oriented sectors led the parade and value-oriented sectors lagged. So what do we use to help us decide where to focus for new money? We use breadth as our tool. We know that in a healthy market, over time, more and more securities will participate in a rally. So if there were 100 companies in a sector at the beginning of a rally, maybe only 10% have been behaving constructively. And as money starts to get put to work, more and more participate until you get to a point where almost everything's performing well. That's the definition of a strong group of securities. At some point when you see weakness, the weakest securities will sell off first, often while the strongest ones in that group continue to perform well. If you're tracking breadth, you can recognize that there isn't enough new money getting put to work, or there's enough money leaving that particular neighborhood where the risk reward levels have changed. What does that mean to us? It means stop putting on any new positions. When we see breadth deteriorate, it means tighten up the stop losses to reduce our tolerance for risk. And for the length of time that breadth continues to deteriorate, it becomes an uninvestable universe for us. So we know there can be times where certain sectors outperform for a long period of time and have substantial breadth, and other sectors can underperform for a substantial length of time. And especially if you're looking at growth stocks, the differential from where a growth investor stops buying and when a value investor is prepared to step in can often be really substantial. So it's important for us to see a turn in breadth. Our job isn't to be everywhere, but it's to identify sort of those areas of leadership, whether that's geographic parts of the world, whether it's specific asset classes or specific sectors or themes. We don't need to be everywhere. And there's times when we need to play defense because there's not enough to do that is constructive. If the broad market is negative, that casts a pall over a lot of securities. So being tactical is what we're trying to do. Make sure that we don't let a little mistake turn into a big one. Now, when we look at breadth started to weaken 2 weeks ago again, and it continued this week. In the US and globally, the percent of stocks in uptrends started to back off. Doesn't mean there aren't some strong sectors and themes, doesn't mean there aren't some very, very strong securities, but the market is narrowing. That tells us we should stop putting on new positions. The second thing that we look at is the percentage of stocks trading above their 50-day moving averages or their shorter term moving averages. That's been deteriorating in Canada, in the US, and globally. Percent of stocks with positive weekly momentum backed off again this week. Percent of stocks making new highs versus new lows backed off as well. And the percent of stocks trading above their day moving average, a 30-week moving average, also backed off. So there is clearly some weakness under the surface. We are in a testing phase. There are some securities backing off. Now, I will highlight that the percent of stocks in uptrends today in the NYSE is substantially higher than where it was in June when the market was making its lows. Very often when a market retests, fewer stocks sell off in the second decline as did in the first. So we want to watch that and see what is it that's holding up, what is it that's giving back the gains. I will note that in the Canadian market, breadth has remained very firm, much better than we've seen in other parts of the world. That's relevant to us being here in Canada. From a global perspective, breadth remained positive in Canada, with about 30% of the companies in the market in clearly defined upper price trends. Most of Latin America has remained positive, quite tied to the commodity markets. Asia Pacific has remained firm. That's important. Middle East also remained positive. India, as a large populous country with a large consumer market, almost 70% of companies in India continue to perform well, but there's some very weak parts of the world. Europe in particular saw deterioration over the course of the last week. The US market saw deterioration, and a lot of the China-centric areas saw weakness, understandably so, with a rise in COVID. When we look at a sector perspective, I think this is really interesting. We talked about over the last 3 weeks, when the market rallies off a low, you want to see what bounces. But more importantly, when the market backs off, what is it that holds the gains? Most notably, two groups that are important to us, oil and oil service, in capital letters means they continue to have solid breadth. Breadth has been expanding. Electric utilities also seeing expanding breadth. Financials in banks and regional banks and Wall Street also continuing to expand. So defensives and reflationary sectors. Lots of groups have backed off. You can see lots of small letters. So let's take a look at some of the charts. One of the things we care about is breadth. The second is whether sectors or themes are performing relative to the rest of the market, especially when you're getting a retest in the market. Here's the XEG, which is the Canadian Oil and Gas Producers Index, certainly pulled back a little bit over the last week. In fact, in the last 3 days, up a little bit, but relative price performance through the bounce and through the correction continued to outperform the S&P. We're above the long-term moving averages. We got rising relative strength, improving breadth. I get it that things have pulled back a little bit, but frankly, this group continues to act very, very well. Outside of carbon-based energy, uranium had a very, very good 2 weeks, sharply rising relative strength, making new recent highs, trading above all the moving averages. And when we look at solar, it's a similar picture. Really, since the early part of 2021, we've seen rising relative strength. So alternative energy, for obvious reasons, performing well. But again, even on a weekday, nice forward advance today for the solar ETF. Lots of companies in this group. So energy, whether we're looking at carbon or alternative, continues to behave well. Now, clearly, if breadth deteriorates enough, there's enough pressure on indices, ultimately they come back and get stronger and stronger groups. So we have to continue to watch. But at this point, the positions within this neighborhood continue to perform pretty well. Now, energy has outperformed, but it could perform for a long time. And despite the fact we've had a little pullback leading up to 3 weeks ago, the energy sector has reaccelerated again since this chart back in favor of E&Ps. Let's move on to industrials. Industrials outperformed through the last part of the sell-off in the market. They also have outperformed since the market bottomed and through the market sell-off. So industrials continue to be interesting. Specifically for us, we're most interested in the defense stocks, and that's obvious as to why they would be performing well. But companies like Lockheed Martin are going to be years replenishing some of the supplies that have been used in the conflict with Ukraine and Russia. From a financial standpoint, this is an important group. You can't really have a great bull market without the financials being on board. And if we're going to have a credit crisis or some kind of economic collapse, you might expect the financials to underperform. I think this is an important tell. Now, clearly, the banks are less levered today than they were in 2008. It takes roughly 40 years for a regulatory cycle to run into enough headwinds where they get significant deregulation and where they make the sector vulnerable again to a major sell-off. But I made the point lots of times, you get recessionary pullbacks in markets, they tend to be 20 to 25%. Credit crisis or financial crisis is generally what drives the second half of a 50% bear market. So unless we start to see real deterioration in the financials, it's unlikely that that's what we're facing, because let's face it, investors are looking into the future and making decisions based on what they think is going on. We know that the brokers, the IAI ETF, has been relatively outperforming since March, and especially since the market made its low in June, without a hiccup either in the rebound or in the pullback in the S&P. So we're always looking for clues. This is an important clue that perhaps things are difficult, but we aren't facing any kind of credit crisis. Now, when I look at Morgan Stanley, for instance, Morgan Stanley's making very close to new relative highs versus the S&P, performing very, very well in a market pullback. Insurance also continues to act well, and we probably have a little more insurance exposure than we do banks. It's a very defensive sector and one that's very well capitalized. So financials continue to act pretty well. Let's move on. We talked about the defensive theme, the sectors that people like to own if they're concerned about the consumer or concerned about spending in the economy. And consumer staples have been leading all year long. That makes sense. From one standpoint, most of these companies have an ability to raise price when their input costs go up. Second, many of them have quite substantial dividends that are supportive to price. So the consumer staples continue to act well. It continues to be an important group for us. Again, we retest under the surface. Are our themes continuing to work, or are they starting to back off? We're ready to sell at any point in time when the price starts doing something that doesn't make sense given what we think we know. But where the fundamental characteristics of the securities line up with the way that the prices are behaving, we want to stay invested so long as that's the case. Moving through the defensive theme also, we've got utilities for obvious reason. Utilities are doing well. Relative price, it's actually relative strength has hit a new relative strength high as of today. It's the only group in the market that's making new relative strength highs versus the S&P. But utilities in North America doing very, very well. And healthcare from a defensive standpoint through this rally starting at the beginning of the bear market and the bounce off the lows and the subsequent pullback in the S&P, we're seeing strong relative price strength. Three groups that all have defensive characteristics, all have yield attached, all outperforming. Comfortable having an exposure here. So that takes us to the dividend theme, which we spent the last 2 years talking about. In a world of rising interest rates, we want to own securities that will pay us a rising stream of cash flows. If you can own a company that has a stable dividend but will grow consistently, it's a great defensive characteristic. Now, I don't want to rehash things that we talked about in previous weeks, but just to highlight, we highlighted last week that since 1986 in the TSX, dividend growers return a little over 10.5% a year. Dividend payers about 9% a year, the TSX itself about 6% a year, and then companies with no dividend or companies that cut their dividend, much smaller returns. All of this came as a free lunch because the group had much lower volatility versus the rest of the cohorts. So dividend growth continues to be a major theme for us. And if we think we saw generational low in interest rates in 2020, we could see many, many years of slowly rising rates. We think that one by one, investors will move away from fixed income and move towards dividend growers as a better source of return with good low volatility. So financials, energy, both reflationary sectors, defensive sectors, the consumer staples, utilities, and healthcare. Second leg. Third leg is a little bit more aggressive, but again, going back to that commodities theme. The metals and mining ETF started to relatively outperform in the late part of 2020, certainly pulled back a little bit into the market lows. Since the market lows has outperformed both in the advance and in the decline. It's a group that we have a small exposure to because we recognize that it's economically sensitive, but we do think that this is the very early stages of a new secular bull market. And at some point, as the pressure comes off the market and comes off the inflationary concerns, we could see this sector perform really well. And we've talked in the past about just how many different metals and materials are going to be required to move to a world of electric vehicles. And there just isn't supply available in copper and nickel to supply the build out of all of these cars without finding new reserves. And it takes a long time. So pricing likely to stay strong, stronger than you would expect, even when the economy is challenged. Just from a thematic standpoint, value continues to outperform on the rally and on this most recent pullback. So that continues to be a major characteristic we're looking at. Markets pulled back about 10% off the highs over the last 3 weeks. Value ETF down about 5.7%, or given back about half what the S&P has given up. And now let's talk about the groups that are problematic. We thought perhaps coming off the lows in June that technology may be prepared to have some substantial bounce. As we talked about, we got to the 200-day moving average, which was declining, and the relative performance started to wane. We had built back a small position. We'd gone from a 2% weight in tech back to an 11% weight in tech, which is roughly 1/3 of the index's weighting. But here we are 2 weeks later. Relative strength has caved once again, back almost to be making relative new lows versus the S&P, now down 13% off the highs over the last 16 days. And as you would expect, we've been stopped out of many of those positions, back to the sidelines. In fact, the QQQ has been relatively underperforming now for quite some time, making a series of lower highs in relative performance versus the equally weighted S&P 500. It could well be that, like in 2000, this group underperformed for a long time. And interesting, during the period that we're looking at here, hedge funds became even more concentrated in the top and biggest companies in the QQQ, now making up close to 70% of the weightings in hedge funds across the US. So when these things start to unwind, there could be a lot of people who decide they need to become sellers or want to become sellers, and fewer people that really need to add positions because they already have significant weights. This is why when a group starts to unwind, it can go on for a long time. Semiconductors in particular have had real relative strength problems. They had a nice bounce, but you can see are now making relative lows. In our long short portfolio, we've been short NVIDIA, which as of today did make a new relative low versus the S&P and versus the semiconductor sector. So weakness in growth. Continuing through growth, communications sector continues to be weak, virtually no exposure here. The REIT sector seeing back off in relative strength as rates have been rising, very little exposure there. And consumer discretionary, of course, if we think there could be a recession, the consumer is underperforming and investors less interested in being specifically focused in areas where consumers make a choice as to whether to spend money or not. Consumer discretionary sector continued to underperform. So it continues to be that there are some strong groups in the market and there are some weaker groups in the market. Consumer discretionary relative to energy, weak. Okay, technology relative to energy, weak. So it's all about picking your spots. I'm not going to say this is easy. It's a really hard market. And we continue to have to make adjustments in our portfolio as days pass. But energy for us continues to be one where we feel the risk reward is strong. Portfolio managers in general are very underweight the group still. It's an unpopular group. And we lump together carbon-based oil and gas with solar and things like uranium. But 17% of our portfolios across the board are focused on energy. And we think as we're coming into winter, it's going to continue to be an important area to be focused in. Industrials make up 14%, close to twice the market weight, because again, governments are less likely to have a choice as to whether to spend money on defense equipment. From a defensive standpoint, the utilities at 10% and consumer staples at 10%, both significantly above market weights, give us a great dividend stream. And the defensive characteristics of sectors that are less levered to the economy. Financials is about in line. And as I mentioned, that's made up of some broker dealers, some insurance companies, and some banks, good dividend support, and good protection against inflation. We do have an elevated cash weight. A month ago, it was 4%. Today, it's 8%. If you put the cash together with a 6% weight in short-term bonds and 4% weight corporate bonds, it gives us close to 20% liquidity across the firm that gives us opportunity to take advantage of the market as it goes forward. Materials is an overweight, but it's still a small weight, recognizing that it's a volatile sector. And then finally, from an underweight perspective, very small exposure to communications, only a 2% weight to technology, 1.5% weight to consumer discretionary, and 75 basis points or less than 1% in real estate. So we do have a very skewed portfolio. And we think that it makes sense in this market. We've got a strong defensive component with cash, short-term bonds, and some defensive sectors. And we have some inflation protection should it be more sticky than people expect, or should the structural undersupply continue to support prices. Geographically, we talked about Canada being the one of the countries that has strong breadth. It remains almost 85% of our exposure as a firm, only 15% in the US. I will highlight that in other periods where commodities started to relatively outperform equities in general, the Canadian stock market acted a lot more like commodities than it did like growth stocks in the US. And in those periods in general, the US market tends to underperform. A few last points. Outside of North America, we do have small exposure to Japan, which continues to show that it is coming out of a bear market that goes back to 1991. We have exposure to India, which also has come out of a long bear market. A little bit of exposure to Indonesia based on the fact that geographically well-positioned as an alternative manufacturer. And on the short side, we are short Europe, and in particular, Germany, which are most exposed to the risks coming from energy markets and the geopolitical risks. So I think that it's a market where we have to keep picking our spots. We're going to have to keep taking new information as it comes. This is a difficult time of year. Now, look, it's likely that we will continue to chop over the next few weeks. But at some point, we're going to come out of this corrective period in a structural bull market. From time and price, what we've seen is something that would be quite typical of what happens in a structural bull market. Volatility refuses to go on to make new highs. I think that's a positive. These are the things that we're watching going forward. Should we see a significant pickup in volatility? These were the different volatility peaks we had on the way through this corrective period, yet to make a new high. Nowhere near where we were in 2020, and light years away from where we were from a volatility perspective in 2008-9. If we're going to have that kind of excessive sell-off, you're going to need to see a pickup in volatility as a clue. From a credit risk perspective, the extra return that a bond investor is demanding to take to buy a corporate bond versus a government bond is elevated from where it was 6 months ago, but not near back to where we were in 2020. And I put a long chart in place to say what a credit crisis looks like. Very significant premium returns expected. In high yield bonds, investors were looking for 17% more for the same maturity than they could get on a government treasury. Today, it's 5%. Not to say it's not important to watch. It is. We'll watch it every day. But at this point, not pointing to a systemic problem. Let's look at earnings per share progression. Expectations for 2023 remain quite stable, looking for about 9% earnings growth. Now, it wouldn't surprise me to see this come down, but at this point, certainly not falling off a cliff, as estimates are remaining fairly constant. Inflation. From our friends at Picton Mahoney, I thought this was a great chart. It measured the number of months in a run-up of inflation in previous bouts of inflation. And you can see this has been a long one already, over 20 months. Not where we were in 1973, 74, and ahead of where we were through the 40s and 50s. But I think that there's an important takeaway here. We talked about the fact that after the Second World War, there was a strong bout of inflation as people went out to buy things that they really wanted. And there was a pent-up demand and there were supply constraints. In 1947 and 48, you had inflation peak at 20%. So what ensued? 20% inflation drove a 24% pullback in the stock market. And once it was over, the market rallied for the next 10 years. So we've seen a 24% correction so far in the S&P. And not to say that that defines anything, but you have to look at previous instances where things happen to understand what can happen. Certainly 1974 was a deeper sell-off, but inflation had become endemic in the system and had been running for years and required a much greater response to bring inflation down. So what's happening? What's most important, I think, is the PMI data on input costs, prices of goods, has started to come down. We know that actual inflation rates versus now estimated inflation rates look to be around peak. So inflation may be coming down. And then I wanted to drag this out. I put this up in the middle of June to highlight the 15 worst starts to a year in the stock market and what happened in the rest of the year. Keeping in mind in 2022 at our worst point was 24%. All of the years that had worse years to start the year coming into June wound up with positive returns. Also, when the market was down 18% to June, it was up 26%. Now, there are some years where we were down 9 or 10 or 12%, and the market was weaker. But the years that everyone wants to compare us to right now are 2008, which was only down 9% in June. So yes, it was down sharply in the rest of the year. It had only just started its correction. In 1974, same thing, down 9% in June. So certainly had a weaker second half of the year. but we were down 24% to the month of June. So my first and base case is that we will retest over a period of a few more weeks, this low that we made in June. We have to be open to the fact that this could be something different. But I think the strong likelihood is we saw the worst point. Now let's talk about one more thing, and that's midterm election years. Midterm election years often can be difficult. Peak to trough for all of these election years gave some negative returns. The average year bottomed on August 14th, down 17%. The median bottomed on September the 4th, not too far from where we are today, down 16%. What's important is what came after. 1 year out, up an average 32%, or a median up 33%. So bear markets wear you out. They sap your confidence. But we have to remain open to the fact that we've seen a lot of negative news and things can get better. We show regularly that when things get difficult, we're willing to raise cash, and we have almost 20% between short-term bonds and cash. We're in a defensive position and the pools are behaving well. We'll continue to go forward step by step, but at this point, I think I'm comfortable with the themes and the securities that we're focused in. And you should be comfortable in the fact that we have stop losses on all of them and nothing is sacred. So with that, if there's any questions, perhaps we can answer them. Now, I don't have Pamela with me today, so I'm just going to take a quick look at the questions. Let's see here. One of the questions from Robert, can we extrapolate information from a point and figure chart of an ETF to an individual security? Absolutely. We run point and figure charts on every security that we run. Point and figure charts are useful because they help identify inflection points where it goes from the odds being in your favor when you're in higher highs and higher lows to when you break lows, probability is lower lows and lower highs. So we run point and figure charts on all of the individual positions and on the ETFs that we follow. And then the last question I had is a view of potential for the forest products sector, given strong government signals there'll be significant housing needs to be built. Yeah, absolutely. We're watching the forest products. They've had strong periods over the course of the year and they've had some weakness. There is obviously some concern right now around housing. I've yet to see a pickup in the relative strength like we have seen in some of the other basic materials. So we watch them, and I think likely they would participate in a commodity bull market. But at this point, we have very little exposure. If there's no other questions, we may call it there. I want to thank everybody for tuning in. If you got questions you were too shy to ask, or you think about after the fact, give me a call. Shoot us a message. My number at the office is 416-601-9033. You can reach me at dburrows@barometercapital.ca. We'd love to talk. And in the absence of that, we look forward to seeing you again next week on our next Barometer webcast. Thanks, everybody. Have a great week.